BTI are down nearly 10% just today. They are down 22% year to date, and they are now at a 52-week low. Let's try and run through and understand why they are down today and whether or not they are still an undervalued company getting to our intrinsic value and acceptable buy price. And we'll also touch upon that dividend safety, whether or not this causes any issues. So the headline reads that essentially British American Tobacco are going to take a $25 billion impairment on their US cigarette brands. So what does this mean? So let's take a look, and we can see here they're essentially going to write down the value of some of their US cigarette brands by $25 billion, and this is essentially due to the response to the macroeconomic headwinds, which they say are hurting their combustible sales in the essential biggest market. Now, when we take a look at this, what they're saying is that the competition from illicitly sold disposable vapes, as well as smokers who are switching to cheaper cigarette brands, and in fact, they also say that some smokers who are quitting have dragged down their US combustible sales, contributing massively to this enormous write-down on the company. Now, when we take a look at what they believe, well, the chief executive has said it was still consistent to building their smokeless world, and what they are aiming to do is have half of their revenues from safer nicotine alternatives such as vapes by 2035. Now, this is a slight worry around the vapes, given that essentially consumers in fact are moving to illicitly sold disposable vapes. So this will hurt their business moving forward, especially if they're aiming to have 50% of their revenue by 2035 in 12 years from this source. Now, in terms of what they're trying to do, we can see here that they have been trying to cut their dependence on the traditional cigarettes by moving to vapes as well as heated tobacco products. But what they are saying is that this has been quite poor when compared to their rivals such as Philip Morris International. Now, they are reaffirming their guidance for 2024, but they are also saying that the global tobacco industry volumes will be down around 3% this year, and we'll touch upon that when we analyse their financial statements. But again, they do reaffirm their guidance for their own revenues this year. They do try to share some more positive news by saying that their commercial plans do continue to show early signs of share recovery, with around a 0.5% improvement in their cigarette volume shares between January and October. But let's be honest, 0.5% right now in the climate isn't going to change this drastically. So it would be good to get a better sense of what British American Tobacco are looking to do over the next few years. We can see they are going to continue to invest in growing their non-combustible business, even though right now it is a low single-digit growth in their revenues, as well as their adjusted profits on an organic basis next year. But what they are targeting is an improvement of around 3 to 5% revenue growth, as well as mid-digit single profit growth by 2026. Now, we can see finally that they have added that it is projected their non-combustible products would be broadly break-even this year, 2 years ahead of schedule. And we can see in terms of the market right now, we're going to analyze this, but the market isn't looking too positive on this news as a whole. And as we said, they are down essentially 10%. Now, they do offer a yield of around 9%, and over the last 10 years, if you were holding this company, you would be down around 38%, and that is not great in all honesty, even with their dividends, but we can see it did have an all-time high of $73. Now, with their latest earnings, how is that looking? Well, over the last 5 years, and what we aim for on the channel is 3 to 7% growth on a minimum, $31 billion in terms of their top line in 2018, $33.4 billion in 2022. So realistically, their top line hasn't even grown by 10%, and that's quite poor when you factor in inflation. They aren't increasing by a minimum of 3 to 4% year on year for inflation. We do have a nice increase all the way to 2020 before a drop down to 2022. Having said that though, we do expect the trailing 12 months to essentially show us a small increase in 23 based off 2022. But again, very minimal growth even if we extend that to the last 6 years. So we'll touch upon that shortly when we analyze the essential metrics. Now, bottom line, $7.7 billion in terms of their net income. We can see December 22, $8 billion. So their bottom line has grown. It is positive to see. It is a nice increase. And on top of that, what is very nice to see is their trailing 12 months shows that essentially their net income should be increasing by quite a healthy amount over that period. So that is very positive. Again, on a more granular level, we do see inconsistencies, a decrease on their bottom line to 2019 before, however, picking up to 21 and then dropping. So inconsistencies in terms of their income statement, although we do note that it is growing over the last 5 years, but not to a very large degree and barely keeping up with inflation. So in real terms, it is decreasing. Now, total cash versus total debt, a quick health check. 3.5 billion in terms of total cash in 2018. From their latest report, around 5.2 billion. So they are holding a bit more cash than they did 5 years ago, just under 2 billion worth. When we compare that numerically and directionally to their total debt, well, that is quite a positive sign. It's gone down from 60.6 billion to 53.5 billion. So their cash has actually increased by just under 2 billion, whilst also decreasing their total debt, which is positive. It is a good sign of the company, especially given how much of debt it did hold December 2018. Now, in terms of competitors, we have Altria Group, we have Japan Tobacco, and we have Imperial Brands, among others. What we can see for BTI, total return year to date, so including those dividends reinvested, they are the worst performing. So not great. Now, when we extend that to over the last 5, we can see that it is in fact up 20% and is actually looking to be the second best performing even after this huge drop today. So not that bad, not great in all honesty, let's be honest, 20% with dividends reinvested, but as always, past performance is never an indicator for the future. Now, in terms of what the institutions are doing, around 7.6% institutional ownership, 1.43 billion worth of sales of the company over the last 12 months, and pretty much the same buying over the same period. So institutions are buying roughly the same amount as they are selling quarter on quarter over the last 12 months. In terms of specifically Q3, a bit more buying than selling. Q2 roughly the same, and Q1 the opposite, more selling than buying. But as always, this is just good as one part of our analysis, and we do need to do our own due diligence. Now, before we jump into the essential dividend safety, we can have a look at their latest quarterly report. Now, when we look at the essential June 23 versus June 22, we do see that their top line does in fact increase, roughly in line with inflation. Bottom line, very nice, triple-digit increase, and we see their diluted earnings per share up 120%, as long as some other metrics sanction positive changes. So their latest report versus 22 does show some nice signs of growth, which is good to see. Borderline safe though, so it is a score of 45, 70 billion, they are still a mega cap company. And when we take a look at some recessionary metrics for those that see a recession inbound, they increased their dividend during the last recession of 07-09. They had plus 5% recession sales, so nice to see. It is above the average growth of companies in the S&P 500. And they also outperformed the S&P for this time, negative 31% versus the S&P's negative 55%. So that is also good to see. Now, we are still waiting for their full year, but the last full year, 1% growth. Not really what you like to see, but over the last 5 years, we do see 4%, and over the last 20 years, 10%, double digits, very nice to see. And I would actually be happy over the long haul with an average of 4%, because if they do give you an increase in line with inflation every single year, you are also locking in a very high 9 to 10% yield, which is very, very good. Now, one thing that is important to note, they are 2 years away from becoming a dividend aristocrat with 23 years of consecutively paying dividend increases. Now, dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. So this is our first sign of undervaluation, but remember, we're not looking at any of these models in isolation. Second sign of undervaluation, the forward PE of 6.2 versus the 5-year average of 8.6. And we do see it is significantly lower than the sector PE at 18.9. Now, in terms of the free cash flow payout, which is very important, you want to be ensuring that it is below 60% because it means their management have that space and ability to give us some nice dividend increases. Over the last 6 years, very, very essentially consistent around that 50%. 2023 expected to be around 51% as well. So very positive. So far, there's no worries why that dividend shouldn't be paid. In terms of free cash flow per share, it is also growing if you look over the last 10 years. Yes, there are inconsistencies year on year, but 195 in 2013, 432 in 2022, and expected 443 in 23 is nice to see the growth over the period. Just understand what type of company though you are investing in. Now, the only issue so far that we've come across with BTI, in my opinion, with British American Tobacco, is the sales growth. I would like to see it consistently increasing at a minimum in line with inflation. We do see 2 years where it did remain relatively flat, although 2019 and 2020 to 2 years either side did show at least that 3 to 7%, which is positive to see, although we do note a very poor period from 2013 to 2015. So something just to keep an eye on, but 2023 is expected to be an increase of around 7%, so I do personally like that. And we can see numerically how this translates to nearly doubling their top line from 15 billion to 28 billion in 2022. Shares outstanding, do note they do issue shares, as we see, from 191 billion to 2.27, so they do dilute your position as a shareholder. ROIC, 10% really is what we like to see. Anything less isn't that great for the majority of companies. They have struggled, but it is nice to see the consistency at 8 to 9%, and 2023 is expected to be 10%, so I would like to see 24 onwards hitting at least that 10% as a minimum. Now, free cash flow margin, operating margin for the tobacco industry, very, very strong numbers, well above the 25%, well above the 20%. So if they continue this, then in terms of the operating and free cash flow margin, it looks to be a very healthy company. Net debt to EBITDA, now this signals the number of years it would take the company to pay off all of their debt net of cash on hand. Remember, we are looking for around 3 as a maximum for the tobacco companies. Now, the last few years, it has essentially flirted around that 3 line, but do note 2022 was below, with 2023 expected to be even lower. So that is quite positive for this company in terms of that dividend safety. So in terms of dividend safety, my conclusion is that it is safe based on the information we have now. And now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or wish list, do click on that pinned comment and grab a copy. The first model, Graham's valuation, we have the earnings per share, growth rate per analyst estimates with that AAA yield. We get an intrinsic value of $48.50. Now that is significantly higher than the current trading price, showing some strong signs of undervaluation and above the 52-week high. So again, it does seem to be undervalued based on Graham's valuation. But as always, we never really look at any of these models in isolation, and we will essentially conclude towards the end. Multiples valuation, so we essentially get the stock price and EPS of each of these competitors that we run through. Average P multiplied by the earnings per share to get a multiples price of $62. Again, some very, very nice upside, over 100% and above that 52-week high. So we have another sign of undervaluation. And then we move on to the dividend discount model. Now the growth rate here does fluctuate. We do see a negative percentage. However, they are paid out in pounds sterling. So based on the FX rate, these will change. They target around 4% increase year on year. I have gone a lot more pessimistic, especially due to the growth that was discussed today being accepted to be lower than what they wanted. So a DDM price of $48. If you do grab a copy of the model, you can play around and put in what you believe in all of these estimates and judgments. $48, again, nice upside to the current trading price and above the 52-week high. So another sign of undervaluation. DCF model, again, free cash flows, the average growth rate. Now, forward looking, they are expecting this to decrease. And with that discount rate, we get to the present value of these future free cash flows and terminal value. Once you add that with the cash, subtract total debt, get to the equity value, divide by shares outstanding, we get a DCF price of $46. Again, slightly higher than the 52-week high, again showing signs of undervaluation in the current market. So the intrinsic value, as always, is just the average of these 4 models. And if you enjoy the content values being provided, don't forget to smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now the share price has been hammered today, and we will start off with a margin of safety of 10%, though we do use this if we believe the company has a wide moat, strong financial metrics and good forward-looking data. Now in terms of 15%, it is still a buy up to $43. In fact, they are having some significant margin of safety. 30%, it would still be a buy, and at 40%, it would still be a buy. If we move to 45%, you're looking a little bit shy of the current trading price. So based on our estimates and judgments, you are locking in around a 40% margin of safety. In terms of Wall Street, they do believe the share price to go up, not as high as our intrinsic value, but they do see up to $38 for the current trading price over the next 12 months. Now let me know your thoughts below with the recent drop today. Are you more thinking that you will be looking to sell your shares, or are you now buying when others may be fearful and adding shares to your portfolio? Let me know in terms of whether or not you do believe it to be undervalued, or you think as a general, the essential industry as a whole is going to be declining and there will be no room for these companies over the next 5 to 10 years. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value and the acceptable buy price of companies in your own portfolio or on your watch list, then do click that pinned comment below. As always, have a great day and catch you on the next episode. Take care.